Hello traders, Douglas here. Today I want to introduce you to one of the coolest and more importantly, one of the most useful indicators for Bookmap. This is called the TTW TradeFinder. All right, now if you look at your screen here, you're going to see what we're going to get into in a moment. I'm not going to go into the details just yet, but these white squares, these red squares, and then you've got these lines with these dots. Okay, so stick with me here because this is going to be really cool. This is a great way to find swing trades, swing highs, swing lows for those big wins, hopefully with smaller losses. Okay, so this is, from what I've seen, one of the best ways to locate potential areas of swing highs and swing lows. Now, of course, everything in trading is not a given. You're not going to just click and make money, so use it in context, but let's get right into it. So I'm going to pull up there. TTW TradeFinder is kind of a suite of tools, all right? So you've got the Market Explorer, the hidden orders, which are stops and icebergs, and then, well, actually, this is just icebergs, straight up icebergs. And then you've got imbalance tracker, the liquidity tracker. I'm not going to get into a lot of this. There's a lot of different odds and ends that you can use, but I'm going to use, just go over my two favorite features, okay? And that's the market volume stop signal. All right, that's in the Market Explorer, is the market volume stop signal. Now let's run down this real quick. You can find sweeps, volume spikes, and absorption in here or other settings, but we're going to leave those all off. Just look at the market volume stops. And then we're going to go over to the hidden orders. And you can have the hidden orders displayed on your chart. You can do a little dome off to the side, kind of like a volume profile for hidden orders. And then you can have a plot at the bottom of your screen. Again, this is also kind of like a volume profile, just laid out in a different way. But we're going to skip over those two and just go into the dynamic iceberg development. All right, it is as cool as it sounds. So let's take a look real quick at what a market volume stop is by TTW's own definition. So this is their website, and you can see you've got the volume spikes, the sweeps, the hidden orders, the imbalances, liquidity changes, absorptions. So this tool does a lot of different things. There's price alerts, dynamic iceberg developments. Okay, and let's go over here and get the definition of the market volume stop. So we all know what a stop run is, but this is detecting it in a certain way. So it says the formula for the market volume stop is a secret. This formula has allowed us to track high probability stop run activity. And before I go any further, I just want to say that it does do a great job. I've taken a look at this at multiple weeks now. I've been testing it, been observing it, and it does an excellent job of what it is designed to do, okay? So you get a signal immediately when stops are triggered during a short period of time. After a market volume stop occurs, and this is the important part, there is a high probability that the market will turn in the opposite direction. So that's that swing high, swing low. If the market later returns to that price level of the stop run signal, it's a retest, and that's a good level to act as support or resistance. Again, of course, everything in context. All right, so that's the most important thing there, and we might as well go down to the dynamic iceberg development, since we'll be going over that too. The DIDs powerfully show the exact development of all single native icebergs on the chart in real time. Each native iceberg has its own individual properties and are placed, shifted, traded, and canceled uniquely. These individual movements and actions are traced by the DID tool, and you must have full market depth with MBO data. Now, you've seen my videos probably on stops and icebergs before. What is different about the dynamic iceberg is it'll show you where it was originally, where it was hiding originally. So you're not going to get to see this until the iceberg triggers. So you're not going to see these levels in advance. All right, that's the point of a hidden order. Okay, they're not going to show you where they are in advance, but you can see after they've triggered. So take a look at this dot here. Price was coming down, hits this level here. So it triggers that there was an iceberg here, and then this line will show you how long that iceberg's been waiting. Okay, and then it comes down, it hits another one, and you see that that iceberg had been waiting in the book for quite some time. So it's probability that this person, this entity, whatever it was, layered in some orders. So they caught some on the way down. These are buy ices, by the way, buy icebergs. So it caught that on the way down, and then price came down. It caught their next level, and that's when it moved up into the direction they wanted. All right, now here's something even cooler. I mean, it kind of shows you if an iceberg is more important or not. Like a lot of times icebergs hit and there's nothing you can use it for. There's no useful information off of the particular iceberg, right? But these dynamic ones, the theory goes, are more useful, more likely to move the market. So price is coming through here. There was this big sell, but you can see this buy ice just smashed into it. They were down here at this level and they just drug the order up, or the algorithm activated or whatever, but it moved from here to here very quickly, smashed into that large seller, and price kept going on the way up. And then there's even more that happened here. Like if we drag this down, there was some strange activity here. It looks like the ice was here, then it moved up here, then they pulled it down here, then it came back up here and triggered. So there was some gamesmanship going on there, but this is one of the more interesting ones that I've seen as I've been watching this tool. I think the more useful ones, like you'll get little ones like this and this, I kind of ignore those. When you get these layers, when you hit 2, 3, 4 layers like that, it's hard to know when that layering is going to stop. But those are very high probability reversal zones, because I believe what's happening is they're layering in their orders, and you know, a big order, they won't want one big order to transact and then move the market away from them before they can fill what they want to fill, right? So they layer in, they catch part of their order here, part of their order here. If it kept going down, maybe there'll be 2 more layers of their order that they wanted to fill. Once all of those layers have been filled, then the market moves in the direction. In this case, there was 2, maybe 3 up here it's hidden by. That might have been part of it as well. It probably was. So they layered in on the way down, as you can see, and then market starts moving up in their direction. And maybe this was even them too pushing the market afterwards, all right? And they're throwing more money behind what money they've already got in here. All right, so that's potential, right? We don't know exactly what's going on. We have to put together the clues and create kind of a picture of what we think is going on, and then make decisions from there. So now let's take a look. I'm going to show you some of this in quote unquote real time. I mean, this is a replay, but I'll show you that these do trigger as the market's coming through and not like minutes later. So let's look at the big picture first, then I'll go back and show you that. But so early in the morning, we got 7:30 Central. So this is an hour before the market opens. You know, price moves up, hits these market volume stops, basically. So you've got these high volume stop run areas. And then, you know, price drops pretty big. It hits this one. I mean, that's a lot smaller than this grouping up here, but it's enough to push price up a little bit before it collapses. And then it just runs through these. So this is what I'm saying. You can't just pull the trigger just because you see a white square or red square come up, okay? So you have to have some sort of structure that you're looking at, some sort of game plan, and you take your shots based on that game plan, okay? So again, this could be them layering in, it could be them exiting the market. You know, you don't know why there's large areas of orders happening. People getting run over maybe through here, you know, they're just wrong. There's multiple reasons, multiple things that could happen. But one thing that I like to do is if I see something like this that goes through and you get all these buy stop runs here, and then the market keeps moving down, So you might get fooled here, you might buy. It does go up a little bit. But then when you see sort of this break in the action, and then it comes and hits another trigger, this is kind of where I like to take my shot. All right, so if it just runs over all these guys, but then you get kind of a break in the market, that's why I say you might have got wrong here. You know, once that trigger happens again, of course, then you've also got the layering icebergs that I was talking about as well to back you up. So this is a great place to take a shot long. Plus you've got all this high liquidity supporting you here. I mean, there's multiple reasons to take this. But here's what I found to be the most powerful part is not just taking shots to get in with a small stop, right? So it comes in, hits this, this volume stop. You're going to want to get in pretty tight. You know, you don't want to be way down here. I mean, if you really wanted to protect yourself, maybe way down here, but you might want to have more of a mental stop kind of, you know, in this layer area. Like this is where the high volume happens. So you're hoping that this is what holds. And it comes back, holds here. So you didn't hardly risk much. And if it broke through there, you wouldn't have lost much. But now you can just hold the price through the games, right? So price comes up and then of course it comes back, because it's not just going to go to the moon without trying to shake people out and fool people, get them on the wrong side. But there's nothing that's happened here. There's no icebergs. There's no volume stops. You know, nothing of interest really. And then it starts moving up, and then it hits this grouping here. Moves around a little bit, stalls out, and then comes all the way back down. You get this guy and this guy. And then I don't think it's any coincidence that then it starts moving up. You might have exited here, you know, might have got out too early, but if you didn't, once you saw this collision happen, hopefully you were still in or you didn't go short here. And then it moves up again. So it's possible that you could have held from here to here. This is probably where I would have got out, depending on how much you were into this iceberg play. Maybe you held it longer. But then we go through and then come up and no coincidence, we get another stop run up here and then it starts moving down and busts through these guys. But if you got in short here, at best you just be exiting here because you're scared. You're probably, this is not any kind of, in my opinion, there's no reason to get long here even though you're seeing these stops. And then we come back up, we hit another one, moves down again. I mean, you can see how often these are right for big swings from there to there, from there to there, from here all the way up here, from here to down there, from here to here. So even if you're getting some of this stuff wrong, this is my point of how powerful this could be. Even if you're getting some of this stuff wrong, and you will, of course, get some of this stuff wrong, if you're hitting 40, 50% and you're keeping these stops, you know, kind of somewhere in the neighborhood just below where these runs happen, and then you're going for these big swings until you run into another run, you know, you could be looking at easily 3-to-1 on your risk. You might get higher than that, you know, depending on how good you become at the game. But that's the way to win in trading, right? Bigger wins than your losses and not by some little marginal space. You know, you want 2-to-1 minimum, 3-to-1's great, 4-to-1, 5-to-1, then you're, then you're getting really good. Then you're getting really good if you get into, you start getting into those high zones and you're keeping your win percentage somewhat reasonable. But I mean, you could hit definitely less than 50% on these swings and still come out ahead and make money. Okay, so let's get to the beginning here. I'm going to run through this, and then I'm going to show you a couple more instruments just to let you know it's not just an ES thing. This works on everything. I'm just going to make this as fast as possible. Okay, so this is that 7:30 I was telling you about. See what I mean? These pop up as soon as it happens. These are not delayed signals. If you're wondering what this green dot is, I've just got Bookmap set to show me very large trades of certain size. So on the ES, it would be a single trade of 100 trades or more, 100 contracts. And this is when it starts running people over. And so you've got these big red dots in here too, showing you that there are some major sell activity going on. And if you're going to have a large sell, you're going to have a large buy. You can't have a large sell without a lot of buying, right? There's always two sides of the market. For every buyer, there's a seller. So it makes sense that you got this grouping of volume market stops here and that they got ran over because you've got the aggressive sellers popping in. But then they exhaust themselves out. There's too much liquidity here to get through. And as you've seen, it goes. Let's see if we can get to that fun iceberg here without running over it. Let's see. Just a little bit too far. Okay. Boom. And you can see that ice got dragged from there to there, and then from way down here to way up here. I mean, there's some serious games going on there. It's kind of fun to see that stuff. All right, so let's get this to the end here. So let's take a look at RTY. RTY is similar. You got this one at the beginning of the day during this sharp drop. It didn't mean anything, but you get a spike here. That works out, works out. That's a tiny win there. It's not really a swing. Comes up here, works out, comes up, up. So, I mean, one of the great things is it does eliminate a lot of areas of trading. Like, it really simplifies what you're looking for. And hopefully you've got some sort of system for support and resistance, for pullback levels, EMAs, whatever you're using to determine where your areas of value are. You want to play these in your areas of value. Don't just play them naked. All right. I think I've said that before, but let's go over. I think I turned ZB on. Yeah. I mean, ZB, you get the stop here, and then that kind of ends up as the level it holds to. Boom, boom. That's pinpoint, pinpoint. So that's ES, ZB, and RTY all showing you similar results, so you can kind of play what you want to play. And that's it. I think this video has gone too long already. So I'm going to put a link down below. I'm going to have a discount on this thing. Just fair warning, man. Stuff in trading that works is not cheap. This works. So no, you're not going to get it for like 10 bucks a month. Stop being cheap. You're going to lose more money than that when you're trading. So use some tools that work. Stop pinching pennies to try to save dollars. Wait a minute. Stop pinching dollars to try to save pennies. I think that's the correct way to say it. All right, boys. That's it. Peace out.